Today, we are taking a deep dive into Walmart. This isn't your parents' Walmart anymore. The retail giant is turning itself into a tech-powered beast, and its stock has been hitting one record high after another. But that leaves us with the big question. Has that train already left the station, or is there still time for investors to get on board?
Okay, let's just start with a number that's almost hard to comprehend. $1 trillion. Walmart recently blew right past that massive market cap, joining a super exclusive club. And what's really wild about this is that it's one of the only non-tech companies ever to hit that mark.
But just as they're celebrating that incredible milestone, there's a new twist. For the first time in what feels like forever, Walmart is no longer the biggest company in the world by sales. That crown, it now belongs to Amazon. And that right there creates the core tension we need to unpack as investors.
So this brings us right to the heart of it. We've got this trillion-dollar valuation on one hand, but a new ferocious competitor on the other. With the stock trading near its peak, what's the call? Is Walmart a buy, a hold, or is it time to sell?
To figure that out, here's our game plan. We'll start with that trillion-dollar question. Then we'll break down Walmart's new playbook, crunch the most important numbers, talk about price versus perfection, and finally, give you our final verdict.
All right, let's jump right into section 1, Walmart's new playbook. We need to understand the strategy that's fueling this incredible run for the stock.
First off, you have to appreciate the foundation. Walmart's empire is really built on 3 core pillars. You've got Walmart US, which is the absolute giant in the room, making up a whopping 68% of revenue. Then there's Walmart International, which operates in 19 different countries, including really high-growth places like India and Mexico. And of course, there's Sam's Club, their membership warehouse that goes head-to-head with Costco every single day. But here's the thing. That traditional business isn't the whole story anymore. Not even close. The real secret sauce for its future is something they call the alternative profit flywheel. And what is that? Well, these aren't your typical low-margin retail sales. We're talking about high-margin services, like selling ads on their website, raking in membership fees, charging other sellers to use their fulfillment centers, and even selling data insights. This is what's really driving their profitability now. And at the center of all of this new stuff is technology. You're going to hear a term called AgenTek Commerce. So what is it? Basically, it's Walmart's fancy new AI model. Think of it like this. They're using digital assistants, like a tool they have called Sparky, and plugging them directly into their massive supply chain to make your shopping trip faster and way more personalized. They're trying to turn a simple AI chat into you getting a product in your hands almost immediately.
Now, it's not all sunshine and record highs. To get a full picture, we have to talk about the bad news. And the big headline recently was that in the fourth quarter, their profits actually fell by nearly 20%. The company said this happened because some of its other investments lost value. It's kind of like if the stocks in your own personal portfolio took a hit. It's a really important detail to keep an eye on. So what keeps Walmart's executives up at night? Well, according to them, 2 major risks stand out. And interestingly, they're both about the climate. First, extreme weather events that can shut down their stores and clubs. And second, those same weather events disrupting their entire supply chain. These aren't just abstract ideas. They are real, tangible threats to the company's bottom line. Okay, that's the strategy. Now let's dig into the numbers that matter. We need to see if the financial reality actually backs up this exciting story. We're going to cut through all the noise and focus on 4 metrics that tell you what's really going on. First up is revenue growth. Look, for a company this enormous, growing your sales by 4.7% in a single year is frankly pretty incredible. We're talking about a company with over $713 billion in revenue. That growth means they added tens of billions in new sales. The core business is still a powerhouse. Next, let's talk about something called pricing power, and we can see it in the gross profit margin. This number tells you how much profit Walmart makes on every dollar of stuff it sells. At about 24.4%, it's actually lower than its rival Target, which sits around 27%. And why is that? Well, it's because Target sells more things like clothing and home goods, which just have higher markups. It perfectly shows Walmart's business model. It's all about massive volume. Now for maybe the most important number on the board, cash. The company's core business generates a staggering $41.6 billion in cash flow every year. You have to think of this as the fuel for the entire machine. It's what they use to invest in new tech, pay out dividends to shareholders, and buy back their own stock. It's a sign of a fundamentally healthy company. And that leads us to free cash flow. The best way to think about this is it's the cash left in Walmart's wallet after every single bill is paid. It's the pure profit they can use however they want. And last year, Walmart grew that number by 18%. So the key takeaway here is not only is the company a cash-generating machine, but the amount of usable cash it has is growing and growing fast.
So the company's story is great, and the numbers are strong. This brings us to the really tricky part, the big valuation question, price versus perfection. Is all of this good news already baked into that sky-high stock price?
Let's break down the two sides of the argument. The bulls, the people who want to buy, will tell you that Walmart is the clear leader in modern retail. Those new high-margin businesses like ads are absolutely booming, and their investments in AI are giving them a huge edge. But the bears have a really strong case too. They'll point to a valuation of around 44 times earnings and say the stock is priced for perfection, meaning there's zero room for any mistakes. Plus, if consumers pull back spending or if tariffs become a problem, profits could get hit hard.
And you can see exactly what the bears are talking about right here. Over the past year, the stock has traded in a range from about $80 to $135. And where is it now? It's right up there, hugging that all-time high. It just confirms that a ton of optimism is already reflected in today's price. So what's the one big thing out there that could derail this whole growth story? It's this idea of the bifurcated consumer. That's a fancy term for a split economy. You've got lower-income families, who are a huge part of Walmart's customer base, really struggling with inflation. At the same time, you've got higher-income shoppers coming to Walmart to find deals. The big risk is that the struggling group cuts back on the profitable stuff, the discretionary items, which could really hurt Walmart's margins.
Okay, so we've looked at the strategy, the numbers, the bull case, the bear case, and that brings us to the moment of truth. It's time for the final verdict. After weighing all the evidence, here's our definitive recommendation. Our official recommendation for Walmart is a hold. Look, this is a fantastic company that is executing a really brilliant turnaround. The problem is the stock's high price already reflects that reality. Based on the company's own financial guidance and our analysis, we are setting a 12-month price target of $120.40 per share. So let's just boil it all down. The single strongest reason to be optimistic is that these new high-margin businesses, we're talking advertising and memberships, are working. They are successfully making the company more profitable. That's the core of the new Walmart story. But the biggest risk, the reason we're not saying buy, is that the stock's valuation leaves absolutely no margin for error if the economy slows down and that growth starts to fade. Now, for those of you who agree that Walmart might just be a little too expensive right now, here are a couple of alternative ideas in the same space. First, you've got Costco. It's a more defensive play with a membership loyalty that is just off the charts. Then there's Target. Now, it has its own challenges for sure, but right now it offers a much more attractive valuation, and its gross margins are better, which tells you it has stronger pricing power. And that's our deep dive on Walmart. It is a retail legend that's doing an amazing job of turning into a tech powerhouse. The catch is, it comes with a premium price tag. The real question investors have to ask themselves is whether its new tech engine can grow fast enough to outrun a potentially slowing consumer. So, what company should we break down next? Let us know your thoughts down in the comments.